plus years of experience in risk management, equity research, and fund management. He has played a key role in developing systematic investment approaches. Joining him is Mr. Sailesh Jain, fund manager at Tata Asset Management with 20 plus years of expertise in fund management, broking and derivatives. Having led institutional derivative desks and worked extensively with quant-driven strategies, he brings deep insights into how these models are shaping investment decisions. Together, they will help us understand how quant-based investing compares with traditional investing strategies and it means for investors in today's markets. Let's welcome Mr. Sharwan Goyal, Mr. Sailesh Jain, and Mr. Aditya Gupta on stage.
Thank you, both of you, for joining us today. And it's a very popular topic, the world of quant. There's an entire AMC about it, and a lot of news. But not many people understand what goes behind these quantitative strategies. So let us understand this better in this session. My first question is to Sharwan. You manage an active quant fund. And you recently launched this. Can you describe the strategy of this fund and how do you differentiate this fund from your other active funds?
Thank you. Thank you, Aditya, for having me here. And I'm delighted to see such a large audience paying attention to so many topics. So, quant is a very wide area. Anything which is using quantitative models, algorithms, or statistical analysis to prepare portfolio is called quant strategy. So there are three broad approaches to portfolio construction. Fundamental way of constructing portfolio. Second one is quantitative way of portfolio construction. Third way is technical way of constructing the portfolio. And in the sense, to some extent, fundamental and quant are linked to each other. So we believe that quant is an alternate way of constructing the portfolio, and it's not a direct competition to fundamental way of portfolio construction, because to some extent even fundamental based portfolio construction use some kind of quantitative techniques to design the portfolio and construct the portfolio. We at UTI in the sense UTI Quant Fund looks at quantitative way of portfolio construction based on factor analysis. If we look at longer term performance of the market, then we will see that there is a lot of cyclicality in performance of these factors. 3-4, in the sense, very well known factors are momentum, quality, value, reward. So UTI Quant Fund dynamically allocate money across these style factors based on performance trends of these factors in different equity markets environment. So there is a top-down allocation across these factors, and stock selection is bottom-up based on factor ranking. So let me dwell a bit on these two elements of portfolio construction. As I mentioned earlier, there is a lot of cyclicality in performance of these factors, right? For example, post-pandemic, we have seen that there was very strong value cycle, while prior to COVID, there was very strong quality cycle from 2017 to 20 period. And the return gap in such cycles is extremely huge. So in last 4 years, from October 2020 to June 2024, which was extreme value cycle, value style delivered 450% absolute return in a market which has delivered just about 120%, 4x returns for value as compared to broader market, right? And post which we have seen that in last 6 months, in a slightly difficult macroeconomic environment, quality style started performing very well. So we use two decision trees, which are quality value indicator and momentum low vol indicator, and these two decision trees are decided based on longer term performance track records of these factors, and based on that we construct the portfolio. As I mentioned earlier, it's an actively managed quant fund, so the portfolio stock selection is basis UTI coverage universe. So we have 14-member research team which tracks about 430 companies, and out of these 430 companies, we remove over 20-25% companies based on liquidity, size of the company as well as governance of the companies, and then select companies basis these type factors. So basically, because of cyclicality in factors, we keep changing allocation across various factors. So currently our model is suggesting about 70% allocation to quality style, which was struggling in last 4 years, about 20% allocation to low volatility style, which is a defensive style and perform much better during tight equity market environment, and remaining 10% allocation towards momentum style.
Thank you so much. And these factors keep on rotating. And not many people understand that when we talk about hybrid funds, and we have been shifting our clients' portfolios towards hybrid almost from the last odd year. And there's a lot of quantitative strategies used for the asset allocation, to determine asset allocation. And majority of the AMCs are using some or the other kind of model to determine asset allocation. And Sailesh, you have worked extensively on the passive and hybrid strategies, and you use an asset allocation model in your equity savings fund. Can you describe the model used to determine the asset allocation? And what was your asset allocation 6 months back, roughly around September versus now?
So thank you team Nivesh, for having me here. Good afternoon, audience, and thank you for giving me this opportunity and hearing me out. So let me start with what we are talking about. Two different funds. One is the balance advantage fund at the moment, which is also a part of the hybrid, and then we are talking about the equity savings fund. Now, in balance advantage fund, what we did was that when we were launching this fund, this was way back in 2019, we realized that most of the balance advantage funds were working on the PE model. What we realized was that when we were only working on the PE model, there were a lot of flaws in that. Either people were using the trading PE or they were using the forward PE. What I was interested with the job of finding a way which would actually ensure that these things are taken care of. I came up with the idea of creating two models on which will define the equity allocation for the fund. The first model was basically the PE-based model, but what we did was that we took the average of the forward and the trading PE. Now, by doing this, what we did was we eradicated the problem of the trading PE when the valuation always looks stretched in a growth market. And also, while averaging out the forward PE, we also took out the exuberance out of the market, because whenever the markets look where the earnings will start depressing, the forward will always look cheap. So when you average that out, it actually takes care of both the things. What we did was that after creating that, we created the bands. So once you have the PE model defined, you have the equity allocation bands around it. So let's hypothetically case that current PE is at around 21.2. So what we have done is that anything about 21 PE will be a 40% equity allocation. Anything which is between 19 and 21, the equity allocation goes up to 50%. So here the band changes, which means your equity allocation increases by 10%. This band is very well kept, is easily available on our website for everybody's perusal. What we also realized that over and above this model, we needed something which captures the momentum in the market. Right? Typically, the momentum is on both sides. Whenever the market is in rally, it extends the fundamental or goes beyond the fundamental. When the market corrects, it actually goes beyond the fundamental sanity levels. Right? So here, if you really see now what we are in this phenomenon where there is too much of fear in the market. Right? Just 3 months back, 4 months back, there was too much of exuberance where everybody was thinking that there is no way to the market. So the point is that we realized that we needed a model over and above this, which will also capture those things. So what I did was that, hypothetically, I'm sure everybody, when everybody gets up in the morning, the first thing, doesn't mean that you get up in the morning and just check your mobile. The point is that the first thing what you look before starting or watching the Indian equity market is basically how the world markets are behaving. The first thing you will look any of the website, you will see that. The second, you will start looking at that, how has been the volatility in the market. And the third, if everybody are quite proficient, then they will start looking at the charts, that how has been the momentum in the market. So what we did was that I realized that these are the most important things. What I did was that I captured all these commonsensical things into a model and objectified it with saying that how much equity I need to add if these things are corrected. So basically I just objectified this thing, and what I get was that I add 10% equity over and above the PE model, or I cut 10% equity over whatever if the PE model has been decided. So let's hypothetically case with the current PE, the model says that 40% equity. And the model part B is saying that I don't think it's the right time for you to invest because global markets are not doing well, whereas it's actually the other way around, where global markets are doing very well now versus India. But the point is that if the model B says that you need to add 10% equity because global markets are doing well, volatility is in control, and your momentum indicators are indicating that you are sort of very near to the bottom, or you're sort of, so you will add another 10% equity. So if your equity PE model is saying 40% equity, you add another 10%. To put it simply, 70% of the equity allocation return comes from the PE band, 30% of the return is coming from the model B. So the model B is actually as important as the model A. This is what the BAF model was based on. To be very honest, this is also a model which actually gives us indication as far as all other funds are concerned in terms of the equity allocation. Now this is for the BAF. BAF honestly has done very well for us from 2019 when we did the NFO. We collected around 600 crores in the NFO. Today it's 11,000 crores. So in 5 years we have reached to this, and clearly the equity allocation worked very well and the equity selection worked very well for this fund. Now coming back to the second question, which was the equity saving fund. What we have done in the equity saving fund was that if you really understand, equity saving fund is actually a phenomenal asset allocation fund. It takes care of a lot of issues which everybody would be facing individually. Now put it simply that what is this fund all about? This fund has three different sectors into it, or three different parts to it. One is that you have the net long equity. You have arbitrage into it, which includes the cash future arbitrage, and you have the commodity arbitrage. The third part is a debt portfolio. So what we have done is that we have restructured this fund with saying that at any point in time, we will have only 20% net long equity, 20% net equity. The balancing figure to make it an equity fund, which is a 45%, which you need to make 65% equity, we will do arbitrage. Now, so basically, let's put it simply, a second question will be 20% net long equity, 46% will go into your equity arbitrage. That makes it an equity fund for all equity taxation. The balance is the balance is basically the option to select between a debt and a commodity arb. So if you are commodity arb, which I think we are the only fund in the whole industry who is enabled to do commodity arb, which includes agri and non-agri. So the idea is that if my commodity arb is delivering me a better return than the debt, then we will put money into commodity arb. At the moment, we have close to 5 to 6% of our money into commodity arb. Commodity arb was delivering anywhere around 9 to 10% arbitrage returns, whereas debt was giving me 7% return. So we deployed money into commodity arb, and the balance will go into debt. The point is that why this fund is superior, because this fund, the objective of this fund is one, to deliver better returns than the arbitrage funds, and two, in terms of risk return, it is one notch below the balance advantage funds. So if you really see the ladder, you have arbitrage funds, which are typically the risk-free funds, then you have the equity saving funds, and you have the balance advantage funds. So for us, if you really pick the equity saving fund, hypothetically, if the market does 10% or 12% CAGR return, which has been the historical return for this fund will deliver anywhere around close to 9% return. So the linearity of the return is very, very good. If hypothetically market corrects another 10% from here, okay, this fund will still deliver a 4% positive return. So what I'm trying to say is that this fund has significant linearity. One, it has the arbitrage angle to it. Second, it has a tons of equity, the net long equity. So if market does well, if market does 20%, it will even give a 12%. So the point is that this is one fund which is a very linear fund. Typically, almost virtually as little risk as you can think of. Even if market corrects by 10%, it still delivers you a 4% positive return. If market goes up by 10%, then you will definitely make 8-9% return on this fund. So it is a very good fund for people who are keeping money into your saving banks, or they are keeping money into FDs. This fund will deliver you FD plus 1% return. And this is with the tax advantage. So your taxation will be short term, which will be around 20%, and long term will be around 20%. So it has a tax advantage also. Post tax, this will be way better than your FDs.
Thank you so much, Sailesh. And Sharwan, Sailesh touched about the momentum factor. And you also talked about momentum, quality, value, low vol. And currently your model says 70% on quality, then on low vol, and then 10% on momentum. And we have seen momentum used very frequently in the market. Can you explain for the benefit of our audience, what do we mean by momentum? And it has been, if we see there is enough academic research, enough data, that momentum has been the most consistent factor over the last 30 odd years. So my question is in two parts. What is momentum, and why have we seen the most correction in momentum stocks over the last 6 months?
See, momentum is basically a trend investing. In a trending market, when markets are consistently performing well, stocks which have performed well in recent past continue to perform well going forward as well. So momentum is based on the hypothesis that whatever has worked in the marketplace in the recent past, the same hypothesis or same set of stocks will continue to perform well in the medium to long term as well. So it's based on that particular hypothesis. Generally, in a trending market, momentum strategy perform exceedingly very well. If you look at longer term performance track record of momentum strategy in India as well as global market, then we will find that momentum strategy is able to perform consistently very well from longer term perspective. Although whenever market trends reverses, typically momentum strategy underperforms, and that's what we have witnessed in last 3 to 4 months period. Mr. Eugene Fama, who is Nobel laureate and father of efficient market hypothesis, he mentioned that momentum is an anomaly to efficient market. Typically in an efficient market, various styles perform well in a different market environment, but they all converge from longer term perspective. But because of consistent better performance of momentum from longer term perspective, he coined this particular word, that momentum is an anomaly to efficient market. The reason for momentum doing well could be multiple. So a couple of reasons could be, generally whenever a particular company reports good results, generally market underreacts to that better performance, or even on the other side as well. So market will keep on rewarding that particular company as and when that company continue to perform well, right? And because of that reason, generally momentum holds on to the performance. Second, as we look at style shift from one style to another, there is a typical 3-year cycle. As I mentioned earlier, in last 20 years, if we draw market cycles in India, typically every 3 years market cycles are changing. First 3 years, value is doing better, next 3 years, quality style is performing well. And then it keeps rotating every 3 years. They could be 6 months plus minus gap, but typically there is a 3-year cycle. Momentum is agnostic to any particular investment style. It is neither linked to quality, neither linked to value. Whichever style is working well in the marketplace, it will shift towards that segment of market. And because cycles are playing out over 3-year period, so momentum will also ride on that particular momentum till the time that particular style continues to perform well. And because of this reason, momentum strategy is performing very well. There is a macroeconomic element to this as well. Generally, there are 4 macroeconomic cycles, 4 macroeconomic regimes. First one is slowdown, then initial recovery, then you have maturity phase, and then extreme rally, right? Generally, momentum strategy underperforms during slowdown and recessionary kind of environment. And because of steady macroeconomic environment in India, we never talk about GDP growth being less than 4% in India. While developed markets such as US and Europe, they go through recessionary phase as well. Because we don't have all 4 cycles, pronounced 4 cycles, that's why momentum effect is much more pronounced in India. And generally, momentum strategy is performing much better in developing countries as compared to developed countries, mainly because of this particular element. As you rightly asked, that in last 3-4 months, momentum has gone through difficult phase. Because after 3 years of very strong rally in the marketplace, the market momentum has reversed in last 3-4 months, mainly because of changes in macroeconomic environment. And because of that, momentum strategy has underperformed. So in this sense, every now and then, whenever market trends are reversing, in that kind of environment, momentum strategy has tendency to underperform. But as and when market trend establishes again, then probably momentum strategy could ride on that momentum going forward. So no strategy can give you 100% results. So that's why generally we advise people to combine counter-cyclical factors. So to get steady return across different market cycle, if you combine momentum and low volatility strategy, which is counter-cyclical to each other, generally your results are much more steady and consistent as compared to investing in a single style. Because no style can give you consistent alpha across different market cycles. So either you have to understand the market cycle and accordingly build your portfolio and keep rotating the portfolio the way we are doing in UTI Quant, or other way is to invest in 2 counter-cyclical strategy so that you are not getting exposed to a particular cycle in a very big way.
Sharwan, you talked about shifting from momentum to quality. So are there specific conditions where you rotate these factors? What made you choose rotate these factors?
Because these factor styles are extremely cyclical in nature, right? Every 2-3 years they keep on changing. If you keep on holding one segment, then whenever that style is not performing well, then in that period you go through difficult phase, right? To ride on that particular element, we have through 2 decision trees, which are quality value indicators and momentum low vol indicators, we have studied past market cycles and then identified common link among these factors. And accordingly, we are changing allocation across these factors. Typically, there is a 3-year cycle. So, at the back end of cycle, my model starts signaling that there is now it's time to shift gears towards other style which is underperforming in a big way. So, for example, value style was doing very well from October 2020 to June 2024. But about a year back, my model started signaling that now value style has performed significantly very well. Valuations are expensive for this style. So now it's time to shift from value to quality. So our model started signaling shift from value to quality about a year back. Whether one can time to perfection, answer is clearly no. Nobody can identify shift in style. But whether one can predict the cycle from next 2-3 years perspective, answer is clear yes. That typically style change every 2-3 year period. So our ability to predict what is going to work well from next 2-3 years perspective is much more better as compared to exactly pinpointing when styles are likely to perform well. So we are more or less using mean reversion characteristics in these styles and accordingly changing allocation across these factors.
Sure. And you both have worked extensively on the passive strategies at your AMCs. And there's always a debate of active versus passive, particularly in US when we see there's a big passive market. And there's always a risk of overcrowding in strategies. So if there are too many active fund managers, then passive would do well. And then if a lot of people are allocating in passive, then active fund managers would do well. How do you see the passive strategies and the smart beta strategies market developing in India? And is it at nascent stage, or is it just coming up, or we are going at a good pace? So, and how do you see a debate between active and passive in India?
So actually a very good question, and why this is actually a question which keeps on coming time and again, and I think this will continue till everyone is alive. So honestly speaking, what are the advantages of passive? Right? Let's put it simply. And to be very honest, Indian people, or rather people in India who are investing now, have started accepting newer passive funds. The first, let me start with what are the advantages of passive, right? One, there is no emotional bias in a passive, right? Absolutely no biases. If a particular stock sector there is a particular fund which is dedicated to a particular sector, you put money into it, it will straight away invest in the stock. It doesn't care about the valuation, where the stock is and what is it right time to invest. So absolutely no human bias, which is actually very good in time. The second part is that no management has a view on that, okay, whether I need to add this stock, eliminate this stock, absolutely out of it. Third part, what I want to say is the cost. The cost is substantially lower, right? I mean, in a normal active fund, you will be charged at 2.5% on your AUM fees, right? Here you will be anywhere around 50, 60, 70 basis points. So if you logically see if this fund you invest for another 10 years, okay, let's put it simply, you will be typically paying a 20% only on the average TER on this kind of active fund. Whereas in a passive fund, you will be paying close to 7%. So your 13% actually net will only come from the management fee. So the idea is that this kind of debate will keep on coming. But the point is that passive, what is happening is where people also make one mistake is that they just jump into the passive without the guidance of the advisors. The point is that you can invest into a passive fund, but you need guidance on understanding what is required and what is not required. So it is very easy to blame a passive fund at any point that if your investment thesis was not. So if you are guided by a person, whether you invest, so assume let's say hypothetically today I want to invest in a mid-cap fund. Now I have the option of investing into an active mid-cap fund or a passive mid-cap fund. I will be theoretically correcting both of the pieces, right? Some will deliver 10% higher or 5% higher than this fund. The point is that was my trend in selecting mid-cap was correct or not is what the question comes in. In a point when your large caps are doing well and I invest into mid-cap, either active or passive, I still lose money. So the point is that is very critical in when you want to select. But coming back to passives, the beauty is that the cost remains very low, and the good part is that the human bias or the emotional bias is out of it. Now, what is also important for us or what we have done in Tata is that we have launched multiple passive funds, which includes your sector, and typically like let's take a tourism fund. Right? So we are the only one in the industry who have launched a tourism fund. Now in India, tourism is growing by leaps and bounds. Mahakumbh is a classical example of what's happening around, right? You have 40 crore people visiting. If the number is correct, then you are almost like you have every third person, leading person has actually visited Mahakumbh. The point is that tourism, if you really see how the hotel rates have moved in, Taj, if you really go, there is no Taj which is available at 10,000, lesser than 10,000 on average, right? ARR, I'm just saying. The number of luxury hotels which have gone up, your travel has gone up, the number of airports which are coming in. So typically, what I'm trying to say is that this is one index. If you believe that India is going to grow, that this is one index you can invest. Now, this is an all-time season. We also have another passive fund, which is like a capital index fund, which is just straight away related to capital markets. If markets in India is going to do good, irrespective of whether where the market goes, if the interest in the market remains, the interest in the passive funds remains. So here, what I'm trying to say is that a lot of passive funds have been launched, which with a different sectoral approach, and those will remain. Those will continue to see interest. So yes, this debate will continue that passive and active overcrowding will always be a question whether overcrowding will. But the point of overcrowding also remains in active fund. The point is that if a particular sector like railways and defense were doing well, everybody was jumping into railways and defense, right? The point is that overcrowding will also remain in active fund. It will also remain in passive fund. The point is that being in which sector or being in which space is more critical than actually thinking whether active or passive at the moment.
Just to add a couple of more perspective. See, active and passive are both same side of same coin, two sides of same coin. So whether you have to select the right product, be it active or passive. One should not get carried away by past 2-3 years returns. As I mentioned earlier, market continue to go through different cycles, and in different cycles, different segment of the market continue to perform well, right? So one advantage of passive is while buying, you know what you are buying in advance. The simplest passive fund is Nifty 50 index fund. When you are buying Nifty, you know you are buying top 50 companies which have stood the test of the time, right? Similarly, these factor strategies have come in a big way in last 5 years. So, but rather than getting carried away by past performance of these strategies, you should understand market dynamics and try to understand in which kind of market environment, which factor strategy will help me generate better return. Typically, in a very strong macroeconomic recovery phase, value style perform exceedingly well. Because coming out of recovery, generally starting valuations are cheap for value style, and then from that, in a recovery phase, generally the earnings growth for these cyclical companies are much more stronger. So generally that segment perform very well during recovery phase. When we look at difficult market phase, then typically quality and low volatility strategy perform much better. Just to give you one example, on 1 year rolling basis in last 20 years, whenever markets have corrected, low volatility strategy has corrected 10% lower as compared to broader market. So which means that in a difficult market environment, this strategy performs much better as compared to any other style. So you have to understand the market dynamics and then accordingly keep changing allocation across these factor styles. Or another way is the way I described UTI quant fund, wherein based on, in the sense, cyclicality of these factors, we keep changing allocation across these factors. So you have to either determine which factor is likely to perform well in the next 2-3 year period, rather than getting carried away by past 2-3 years, because cycles keep changing every 3 years. The worst way of selecting fund is selecting best performing strategy without understanding which style that particular fund is following. So one should pay attention to these elements while portfolio construction.
Correct. And now come to a relatively less understood topic, particularly very relevant for this audience, about arbitrage funds, and you both manage arbitrage funds in your respective AMCs. My first question is to Sailesh, if you can explain what is arbitrage in simple terms to our audience. You also mentioned about commodity arbitrage, but what is arbitrage, what does it mean, and how does it act as an alternative to fixed income?
So yeah, so I think let me take through in a very simple to start with, am I audible? Right? Yes. So let me start with simply arbitrage in a very simple academic term is a riskless profit. And what do I mean by riskless profit is let's take it in a very academic, that if you are, is everybody from yes. Or okay, so forget about it. Let's put it simply that you buy from an X market in India and you sell in a Y market by making a profit. So let's take if you're buying an apple in an X market and you're selling in, and we are not taking the transportation cost now, okay, we're just excluding that for the moment. And you sell the same apple in a Y market and by making a profit. This is nothing but a riskless profit. In a very academic term, this is an arbitrage. Now, in an Indian context, okay, in an Indian mutual fund, what does it mean? It means that what we hypothetically do is that we buy equity shares of, let's take an example of a Reliance industry. So Reliance Industries, we buy 100 shares of Reliance Industries at an X price, and we sell 100 shares of Reliance Industries futures. So basically the underlying, which is Reliance, remains the same. So you buy equity shares of the same stock and you sell equity share of futures of the same stock. The futures could be either the current month or the next month. For simplistic, we'll keep the same month. Basically, so if we are in the February month, we buy the equity shares of Reliance and we sell the futures of the February. Now, if you really see, there is always a premium. Basically, the difference. And what is premium means? The future will always trade higher to the cash. And why it trades higher? Because it works on the principle of interest rates. Now, why it works on the principle of interest rates is that in a future you only pay margin. Okay, you don't pay the full amount to buy the lot. I think if everybody is traded futures, they will know that when you buy a future lot, you only pay the margin. That money is kept in the bank, that earns you interest, and that interest is nothing but the premium on the futures. So basically, the whole theory of explaining is that there always be a future should always be at a premium to the spot. Now, these futures, because you have physical delivery, which means that if you are a long future or a short future, you will either have to take delivery and on the expiry day or sell delivery, okay, or give delivery. So let's take how the trade is settled for us. We are long equity shares, we are short futures trade. Okay, this trade when we do the trade we make money because the difference is basically already locked in. Now if the price of Reliance goes up, we make money on the equity shares, we lose money on the futures. If the price of the Reliance goes down, we make money on the futures which we are short and we lose money on the equity. Now why I am trying to say is that there is absolutely no price risk, which means that we make money on one segment, we lose money. The difference between the cash and the future is our profit, which remains intact. Okay. Once you have set the trade, the profit is locked in, your profit is intact, it is realized on the expiry day. On the expiry day, what happens is that because it is physically settled, your futures will settle where the spot is, which means where the equity shares trading. Which means whatever profit you have captured or the difference you have captured between the cash and the future or the equity and the future is your locked in and you make that money end of it. This is absolutely how an arbitrage fund makes money in Indian context.
And also, are arbitrage funds in India allowed to take any net equity exposure?
Okay, so let me put it simply. And again, sorry, I forgot to try to answer this question. But on the equity, on how the portfolio is constructed, if you invest 100 rupees into your arbitrage funds, and why these funds are comparable to debt funds, is that the first 22 rupees will go into your margin money. This is money which is kept in the exchange against your futures position. Then you have the 65% minimum because it is an equity fund, taxed like an equity fund. You will need to maintain minimum 65% into your equity shares your money. So your 65 to 70% of your money, depending on the fund, whether will go into the cash future arbitrage activity. The balance is kept into the debt. This is how the portfolio is constructed. Now, why these funds are superior to the debt fund? One, it is equity taxation. There is a tax arbitrage in these funds. Two, there is absolutely or virtually no risk in this kind of funds. There is no price risk because your positions are completely hedged right from the day of initiation. Long is hedged with the short or the short is hedged with the long. So typically no price risk. The profit which is captured is your absolute profit. This will be realized at the end of the expiry. There are times when you can even realize profit before the expiry if the spread moves here and there. So here if you compare, these funds are comparable to liquid and ultra short in terms of your risk and return. But they are superior in terms of return profile versus both the funds because one, at the moment the absolute returns are higher and second is a tax arbitrage. So tax advantage is significantly. If you are holding a debt fund, you need to hold minimum for 3 years to qualify for a long term. Whereas in an equity fund, your holding period is only 1 year. So your differentiation is substantial when you are holding an arbitrage fund for a year and when you are selling a debt fund within a year. Now the third part of the question was that
that was the question that about arbitrage funds and banks. Compare to the debt fund. And now,
so you have the open position. So no arbitrage fund in the industry at the moment takes any open position. At least for Tata arbitrage fund, I can assure you for the fact that we have never taken a single open position. Neither we will ever have a single open position. For us, it is very clear. The trades are completely hedged right from the very beginning of the trades.
Okay. And Sharwan, as Sailesh mentioned, there is no price risk, but there is some kind of risk in the volatility of the returns. So, what drives the return in the arbitrage funds? If you can explain that.
So, as Sailesh mentioned, that arbitrage funds are completely hedged at all point in time, which means that even if market corrects 10%, you will not generate negative returns on arbitrage funds because always same number of shares are bought in cash and same number of shares are sold in future. Typically, arbitrage funds perform much better during bullish and volatile equity market environment. The reason being, in a bullish equity market environment, people who want to take long position, they do through futures, and they don't mind paying slightly higher spreads to arbitrage funds. Because as long as they make money in futures, or as long as they keep making money in a bullish market environment, generally spreads are higher because demand supply is in favor in such market environment. Second, generally in a volatile market environment, the churning opportunity from one stock to another stock is much better. Because in a volatile market environment, some stocks could be witnessing lower spread in futures, some stocks could be having higher spreads. So in such cases, we exit position wherein spreads are lesser and get into other stocks which are offering higher spreads. So generally, bullish and volatile market environments are much more better for arbitrage funds as compared to continuous weak equity market environment.
Thank you. And if people are confused with a lot of jargons, I will just simply put it, arbitrage funds are particularly for individuals who come under higher tax brackets. It becomes a post-tax better alternative to your fixed income products. Because it comes under equity taxation. So simply put this. Thank you so much, Sharwan and
I
Sailesh.
just want to add one point with the arbitrage fund. Every budget, there is always a discussion done that it will be taxed, it will be taxed, it will be out. I want to add that if you really read the budget document, 77,000 crore is the estimated STD collection by the government. There is no way they can, logically they should not tax arbitrage fund. It's a significant contributor to STD.
There is always a debate with banks and the AMCs. AMCs want their products to be more tax effective, where banks want their products to be more tax effective. So that this debate goes on. Thank you so much, both of you. If we have any questions from the audience.
Yeah, hi. Either of you can answer. In your passives, how frequently do you rebalance, or the industry, how frequently does it rebalance? Is it monthly, quarterly, half year? And is that an important factor to look at for an investor while taking a decision?
So typically for most of the passive funds, rebalancing frequency is on half-yearly basis. So simplest passive fund is Nifty 50, wherein this particular index is getting rebalanced on half-yearly basis. So every year, March and December end, this particular fund is getting rebalanced, or this particular index is getting rebalanced. The logic for rebalancing is whatever essence that you are trying to capture through this particular passive fund, that keep changing. The fundamental data keep changing. So let's say in case of momentum strategy, you want to capture the essence of what is in momentum in recent times, right? So that's why every 6 months you are looking screening stocks based on best momentum strategy, and then likewise keep changing the portfolio. So typically most of the indices are getting rebalanced on half-yearly basis. Some of them could be getting rebalanced on quarterly basis, but generally the proportion of such funds is much lesser as compared to funds which are getting rebalanced on half-yearly basis.
This frequency is set by the exchange, by the index launched by that particular exchange.
Absolutely. So in a sense, all the passive funds are constructed by index providers. Aim of AMC is to replicate the benchmark so that the fund generate returns which are very close to benchmark. So that's the aim of any passive fund manager.
One point that I want to put, and I always want to communicate to all my investors, is that particularly in mutual funds and index funds, if they are rebalancing on their own, there is just transaction cost. There is no capital gains cost there when the mutual fund or an index is rebalancing. But when you are replicating it in a PMS, or when you are replicating in your individual equity portfolio, you have to pay capital gains tax every time you rebalance. In mutual funds or in index funds, you have to pay tax only when you redeem the units. The internal churning of the fund doesn't get taxed. There is only transaction cost. So it becomes a lot more tax effective alternative when you're investing in an index fund or a mutual fund.
Absolutely. Just because of this feature, you can cover your cost.
Thank you so much, both of you. Thank you.